how do you actually avoid losing money in investing? Because it gotta be quite hard, right? Because you can't tell the future, can you? Well, there's actually a few things that you can look out for that will really help you to not lose money. To find these, we first have to look at ways that you generally lose money in investing. And the first of these is when you buy a stock that's overpriced. Now, how do you avoid buying this? So, first of all, a stock with a high PE ratio is generally overpriced because that means the earnings that the company is getting are not justified by the price. And so the way you find out if a company actually has a high PE ratio is you look at the industry average of the PE ratios and then see where your company is sitting, if it's higher or lower. And lower is generally better. So, a general rule of thumb in investing is that if you have a PE ratio lower than 10, it's generally a good value company that's quite good and safe to invest in. The next thing you can look out for when trying to avoid investing in a overpriced company is the ratio of its book value or its net asset value to its market value, so its market cap. So this shows you how much over the market cap a company is actually trading at, or under if you're having a good investment. So generally, if your net asset value or book value is very small compared to your market cap, this means your company is overpriced because its price doesn't reflect the true value of the company because it's much higher than the actual value that's found in the net asset value. Another way that you can find out if a company is overvalued is if there's a high media coverage. Generally, a high media coverage of a company, positive media coverage, this is, generally shows you that the company is starting to become overpriced and is generally likely to fall in value in the future. This is because when a company has a high publicity, like a lot of people want to invest in it, generally you get this mass investing in, right? And then the values, the PE ratios, and that ratio I was speaking about before, your net asset value to your market cap, go way up and are much worse investing conditions actually. But the media says it's great investing conditions. And so this is generally time to sell when there's a massive media coverage, because then you realize a huge profit. And they generally start to fall the prices as soon as the media coverage disappears. Overpriced companies aren't actually that bad. I mean, they're terrible investments, but you won't lose all your money in them. They're still generally decent companies. They're just over-publicized. But there's a lot worse investments to make. These are investments where the company is doing something under the board, right? So, for example, if your company is doing accounting fraud, for example, and you might be wondering, well, if they're doing fraud and the government hasn't found out about them yet, how am I meant to know that it's a bad company to invest in? Well, you can't really, but there are a few things to look out for. For example, if they have a very complicated accounting structure, so reading their financial reports is just like reading gibberish, then you know that they probably could be doing something that's not quite legal. An example of this is Steinhoff, a South African company that had very complicated accounting systems. Everybody thought it was the best company in South Africa at the time because nobody knew that their accounting was actually like cooking the books to make their business seem better than it actually was. But when that came out, the company's value dropped like a stone. And in fact, it's gone into liquidation now, which means the company's just basically completely gone bankrupt. So, companies with a accounting system that's very complicated generally aren't doing very good things. Another example is Enron, but I'm sure you already know about that. Another red flag when investing is a company that's going through a court case, a court battle. Because unless you know a lot about law, or at least that specific area of law, you don't know if they're going to win or not. Now, generally these companies look very cheap for their PE ratios and stuff, and so they might be very attractive investments if they win the case. But if you don't know about the law, don't invest in them, because you don't know if they'll win or not. If you are a lawyer and you know about the law and you know who's going to win the case and if they're going to win the case, then sure, invest. But if you don't know what's happening and you're confused a little bit, trust me, just save your time, save your money, and don't invest in the company. Warren Buffett probably gives some of the best advice to not invest in bad companies. And this is to only invest in what you understand. So, let's say there's this new company called Metamobile, and it's creating this brand new software that will change the world. But you don't know how it works or anything like that. Don't invest in the company. If you don't understand the inner workings of the company, you should never invest in it. For example, Warren Buffett said he'd never invest in Apple because he didn't understand their business. So, let's see. Why would he say that? Obviously, they're selling phones, right? It's quite obvious. But he didn't understand why they continued to be so successful. So even though he might have got massive gains by investing in it, he decided to be safe and not lose money and only invest in companies that he understood the value of and understood why they kept flourishing. And you should do this too, or else you could seriously lose out when you overestimate your knowledge of a company and then end up getting hurt by it. If you found this video helpful or useful in any way, please do consider subscribing. I'm a very small channel about investing, and I'd love to push investing to more people so more people can become financially free and successful.